Right, good morning, everyone. Just letting a few people join in, and thanks for joining us in our latest webinar, looking at some of the tax relief that's there and available that maybe is going unclaimed. There'll be an opportunity to ask any questions at the end. We'll have a quick question and answer session. But thank you to all those joining us. And today we've got Kirk Vaughan, our tax director, who's going to run through the various things that you could look at doing, be it company, personal. There's a few elements for everyone. So hopefully you'll get something out of this. If there's any, like I say, any questions, please do ask and we'll try and cover those at the end. And if you've got any more detailed queries after that, please contact us directly or your usual Knights Lowe contact. And we look forward to speaking to you then. So I'll pass you over to Kirk, who'll start running through the slides, and I'll monitor the questions. And if there's something very pertinent that someone's asked during, I'll butt in. But other than that, I'll let Kirk run you through that from there. Okay, thanks a lot. All right, Kirk, over to you.
Yep, thanks, James. So I've pulled together a quick agenda of the main topics that we're going to be looking at today. I mean, the remit of this webinar today is really to try and highlight to you the areas where you may be able to save some tax or reduce your tax liabilities. We're not going to have enough time to go through all of these reliefs in a great level of detail. I will try and give you a quick overview of how the relief works. But for example, research and development, I could easily talk about that for more than the half an hour itself. So it will be a quick flyover the various areas and just, like I say, trying to highlight where there might be the opportunity to make a claim so that we can then take that forward and look into it further. So like James said, there's various business reliefs we're going to be looking at and also various personal reliefs. And the first one we're going to look at is research and development. There's been statistics that have come out from HMRC that suggested that there's about £84 billion of unclaimed R&D credits, and that they reckon there's about 80% of companies that have underclaimed. So there's a huge amount of relief which isn't being claimed by a lot of businesses. There's two different R&D schemes. There is one for small and medium-sized enterprises, or SMEs, and there's one for a large company or a subsidiary maybe of a large group. And to qualify as an SME, you need to have fewer than 500 employees and either need to have a turnover of less than 100 million euros or a balance sheet total of less than 86 million euros. So to be a large, or to qualify for the large scheme, it is quite a decent sized company or group. Otherwise, you will qualify for the SME scheme, which is the more beneficial scheme to be involved in. So a quick overview of how the relief works. For the SME scheme, there you get an enhanced deduction for any qualifying costs that relate to the R&D project. So for example, if you've got £10,000 worth of costs, and I'll go through what costs qualify in a minute, then you will get tax relief on the £10,000 you actually spend. But then you will also get a further relief for another 130% of those costs, meaning that you actually get relief for 230% of the costs that you spend on R&D activities. So in my example of £10,000, you'll be looking at getting relief of £23,000, sorry, for that £10,000 of actual expenditure. So you would get that deduction from your taxable profits, and that will reduce the amount of corporation tax you are paying if you are a profitable business that would normally pay corporation tax. The SME relief also has the ability to exchange the R&D losses for a payable tax credit at the amount of 14.5% currently, which can be quite useful for a lot of businesses who are obviously in a loss-making position, which is quite common for companies that have quite a higher level of R&D activities. and that loss is capped at the lower of the loss made in the year and also the R&D costs that have actually been incurred in the year. There was proposals to cap this tax credit, which is paid out further. It was going to be linked to the amount of PAYE that the company pays each year, but those rules have been delayed, and as far as we're aware at the minute, we're not sure how or when those rules will be introduced. In comparison, the large company relief, so we see that for some of our clients where they might be, for example, a subsidiary of a worldwide group or something like that. They get the R&D expenditure credit relief, whereby they get a taxable credit paid, which is the equivalent to 13% of the R&D expenditure. And it was a 12% credit before April 20, so that amount has recently just increased. So I think the easiest way just to show you how valuable this relief is to many businesses, I've run a few examples here. So we've compared the SME regime for a loss-making company and also a profit-making company. And then we've also looked at how that compares to a large company, which is making a claim under the expenditure credit scheme. So in each of these examples, we've got qualifying expenses towards the R&D project of £200,000. Obviously, there will be claims that are smaller than that, and we see claims that are larger than that. So obviously, the figures will change for every business, but hopefully this will just give you an idea of the level of tax relief that can be received through the scheme. So for a loss-making company, you will get the deduction of £200,000 from your taxable profits. You will also get an enhanced deduction of £260,000. So that is a further reduction from your taxable profits for the year, meaning you get total relief of £460,000 from the profits, or will increase your loss by £460,000 for the year. That £460,000 can then be exchanged for a tax credit of 14.5%, again, assuming this company is a loss-making company, which means the company will benefit from a tax payment from the revenue of £66,700. So I'm sure you'll all agree that is a very valuable benefit for that company to receive that cash so they can reinvest that into the business. The profit-making company, so it would get the same deductions as the loss-making company. The profit-making company won't be able to exchange those expenses for a tax credit, but what it can do is it can deduct the amount of corporation tax that it's paying. And you can see there the benefit to this company is actually greater because they're able to benefit from a reduction in corporation tax of £87,400. So again, very valuable for that company. The profit-making company who is part of a large, either a large company or part of a large group, they will be able to get a tax credit at 13% of the expenditure, meaning they will receive £26,000. That is a taxable receipt, meaning it will need to pay corporation tax of about 19%, so just under £5,000 of corporation tax to pay, meaning that it nets about just over £21,000 after corporation tax has been deducted. So as you can see, that's the value to the three different scenarios of making a claim. I'll quickly just run through the qualifying costs. So the main cost we often see is staffing costs. So we can claim for the gross salary, employer's national insurance and employer's pension towards the proportion of the employee's time that is spent on R&D activities. We can't claim for things like certain benefiting kinds like company cars or private medical insurance and things like that, but the salary element will qualify. Software costs towards R&D activities will also qualify, as will consumable or transformable items. So we're looking at things like heat and light, water, and things like that. And we can also claim for subcontractor costs and externally provided workers, although those costs are restricted to 65% of the total amount you pay. There are different rules if the subcontractor or externally provided worker is related to the company that is making the claim, which effectively the costs are restricted to the actual cost by that company of providing the services. So the main point I'd like to just run through is, when can a claim be made? So where is there the opportunity to benefit from this relief? Now, R&D is described, or the definition of R&D is a project which seeks to achieve an advance in science or technology. There is a common misconception that to benefit from this relief, you need to have a science lab with some scientists with white lab coats and things like that. And naturally, those kind of businesses probably will be able to make a claim, but the definition is actually a lot wider than that. And we're really looking at, it can apply to a number of different industries and sectors as well. So we're really looking at advancing knowledge or capability in the field or industry of the company. So that can be any industry whatsoever. It could be construction. It could be, anything to do with computers or software. It can be in marketing. It can be in pretty much every business has the opportunity to make a claim, depending on what they're looking to do. I think a good starting point in terms of whether there's the opportunity to make a claim is there any uncertainty in what you're trying to do? If you're trying to do something and you know exactly what you're going to do and you know it will work and you know how to get around things, then it's not going to qualify for R&D because there is no uncertainty there. There's no problem solving, if you like, involved to try and create new science or technology in that field. So if you're looking at something and you know roughly where you're trying to get to, you don't know exactly how, and you don't know whether it will work, then I think that's going to be a good indication that there's probably the opportunity to make a claim on that project. Another misconception is unsuccessful projects can qualify. If you try and achieve something and you're unable to, that's actually a very strong indicator that what you were trying to do was actually research and development, because you've tried to do something and it hasn't been possible, presumably due to the lack of science or technology to enable you to get to the desired outcome. So that's a strong indicator that there might be the opportunity to claim R&D as well. Again, it doesn't have to be a new product that you're producing. It doesn't have to be a significantly step or improvement in existing products that you're producing maybe. It can also be alterations. So you might be adjusting or slightly changing what you've already got to make it maybe more tax efficient, not more tax efficient, more energy efficient. It might use less materials. It might be quicker than what you've previously done. It could be a number of different things that can also qualify for the relief. Improved services and processes can also qualify, so it doesn't just have to be new products that you're trying to produce. And then the important thing is, once we've identified that there is a project that qualifies, or there's an element of a project that might qualify, we've got to then try and break down and understand the costs that relate to the part of the project that contributes towards the resolution of the scientific or technology uncertainty. So, for example, it's not the whole project that will qualify. If there's any costs towards the aesthetics or the marketing of the new product, or whatever it might be, then those costs won't qualify because they don't contribute towards the R&D activities. But I think the important thing is trying to give some thought as to what has happened within your business, what activities might qualify. Once we can identify the projects or the activities that will qualify, then it's a case of trying to pick out the costs associated to those projects. So that is a very quick overview of research and development, and hopefully where we can try and spot some opportunities to make a claim. The next thing that I was going to speak to you about was Capital allowances, again, it's estimated that £80 billion is unclaimed in capital allowances, and that's mainly on integral features and also for fixtures in commercials properties. So capital allowances is effectively the tax relief that you can receive on your capital assets or fixed assets within a business. I think most businesses will claim capital allowances on things like vans and computers and furniture and things like that. But when it comes to buildings, we often see that there's a lot of businesses that aren't necessarily claiming all of the tax relief on those that they can. So residential property won't qualify for capital allowances. There is a bit of a different rule for furnished holiday lets, which I'm not going to go into today. Really what I'm going to focus on today is commercial property, where you can claim capital allowances on integral features, which will be things like the heating components, electrical systems, air conditioning, lifts, moving walkways, things like that. And also fixtures to a building, so signs, built-in cupboards, fitted kitchens, bathrooms, things like that. Fixtures are effectively things that are stuck onto the building, if you like. So you can't claim, or generally you can't claim capital allowances on the structure or building itself. So things like floors, walls, ceilings, windows, you can't claim tax relief on those kind of costs, but you can on various aspects of that property. So what sort of scenarios are we looking out for where businesses might be able to make a claim? And it's just worth highlighting that when I say businesses, rental businesses will also be able to qualify. So if you've got a business with possibly the business owner owns the commercial property outside of the business and rents or receives a rent from the business for the use of that property, then that business owner can personally claim capital allowances to offset against the commercial rents received as well. But the kind of situations we're looking at is, first of all, new commercial builds. So if you're building a new factory, unit, office, whatever it might be, then it's going to be important to work through or probably visit the site, understand what is made up of that property, and have a look through the costs incurred to build that property to try and pull out the elements of the build cost that can be claimed for tax relief. Likewise, any sort of improvements to properties. So that can either be where you've had a property for some time maybe and you decide to put in a new kitchen or extend the property you've already got. Then again, it's looking to pull out the qualifying costs within that. But also leasehold improvements as well. So we've seen clients that have bought an empty shell of a property and sometimes have spent quite a significant amount in fitting out that property that they've got a leasehold interest in. And it's the same basis where it's just a case of trying to understand what of those costs or which of those costs would actually qualify for this relief. There's also the option to claim relief when you're acquiring a property. The rules here were changed a few years ago and are quite complicated. But essentially, if you're buying the property from another party, then you have to agree the split of that property which can qualify for capital allowances. And it is a negotiation point, because what will happen is, based on that split, or it's called a Section 198 election, it will then be a case that the purchaser will be able to claim relief on the element of fixtures and fittings, and the seller will have to account for tax on that same value. So obviously it's going to be in the buyer's interest to agree as high a figure as possible, and it's going to be the seller's interest to try and negotiate that figure down as well. There is also a pooling requirement, which means that the purchaser can only claim capital allowances if the seller has claimed capital allowances on those costs themselves. Now, we have seen circumstances in the past where no capital allowances have been claimed, or very few capital allowances have been claimed by the seller, and we are able to still make a decent sized claim, because what we can do is, if we can identify the amount of capital allowances the seller could have claimed, they can actually make a claim in their final tax return for capital allowances, and then also bring in the disposal proceeds that's agreed by the joint election, meaning that the purchaser is able to still benefit from those capital allowances. So again, it's worth noticing, or it's worth noting, that if you're buying a commercial property, the value of capital allowances can make a massive difference to the amount of tax relief that can be claimed. And if you're up to speed and aware of the situation here, you can actually work out with a much better deal when buying a property by using these rules to your advantage. To give you an idea of the rough sort of range, if you like, of a claim of a total build cost, we're seeing claims of between 15 and 45% of the property purchase price or build price. And it varies quite significantly, because you might have, on one end of the spectrum, you might have a pretty empty shell of a unit with not a lot within it. So you might just have the electrics and plumbing and not a lot else. And then in comparison to that, you might have some offices or, you know, a more bespoke building that's got quite a high level of fixtures within it as well. Just to give you a quick example there at the bottom, we've recently made a claim on a purpose-built dentist surgery. That property claimed capital allowances of £325,000, which will result in future tax savings to them of £61,000, or nearly £62,000. So it is quite a significant tax saving that can be claimed, again, by maximising this relief. So the other thing I just wanted to add is there's a new relief that came in from the 29th of October 2018. We haven't seen it too much yet, but it's called the Structures and Buildings Allowance, or SBAs. And like I said before, previously it's not been possible to claim tax relief or capital allowances on the structure of a building itself. So again, we're talking about the walls, the floors, ceilings, windows, things like that. However, if there's any new builds of commercial property that are built from the 29th of October 2018, then we're able to claim an annual allowance which is equal to 3% of the build cost. And that's recently just gone up from 2%. So those percentages are quite low, but we're typically talking about quite a high value number. The value of the property can obviously be quite a significant amount. So that can add up to be quite a valuable relief as well. So if there's any new properties being built, it's just worth being aware of that one as well. Another area where we often see clients where they're probably paying more tax than what they need to or required to is the way that they pay themselves. And there's a few sort of common things that we tend to find with directors' remuneration packages. The first thing is, have the directors or business owners got a tax efficient level of income? So there we'll be looking to make sure that they're utilising their personal allowance, the tax-free amount you can receive every year. Typically we'll be looking to utilise their basic rate band as well, making sure their income's at least £50,000 a year, and also retaining their personal allowance. So when your income, your total income exceeds £100,000, you start to lose your tax-free personal allowance that you're able to receive. So the trick here is really that rather than having your income at, for example, £125,000 one year, so you lose your full personal allowance, and then it drops down to £70,000 the next year, so you're not utilising that full £100,000 band. If you can plan it so that your income is more stable year on year, then you can lower your overall tax payable on a cumulative basis by just sort of monitoring and maintaining a steady level of income, which is at a tax efficient level. Another one we often see is trying to utilise families or spouses' tax allowances as well. That can work really well where you've got family members that work within the business, or it might be that shares can be passed to family members to utilise their dividends allowance, their basic rate band, or whatever it might be. So that can often work really well as well. It's also not just a matter of what your income levels are, but also the way you pay yourself can have a big difference to the tax liability as well. So when we're looking at companies, we've got the choice very often between whether salary is paid or dividends are paid, and in some cases whether they receive rental income as well for the use of a business property. So typically it will be better to receive a lower salary and higher level of dividends, but the tax rules are quite complicated when looking at the personal tax cost of individuals these days, so it's not always the case, but just keeping an eye on how you're paying yourself is important as well. There's also a number of tax-free and tax-efficient benefits which can be utilised. Pension contributions is a very tax-efficient way of getting money out of the business. Company cars, they have a very differing tax cost depending on the type of the car you go for. On one hand, you've got electric vehicles, so pure electric vehicles, which currently have no benefit in kind, so are very tax efficient. You've also got hybrid cars and vans that are tax efficient as well. On the other hand, if you've got a diesel guzzler with a sizable engine in it and is likely to have very high CO2 emissions, which is what the benefit in kind tax cost is based on, then it might be worth not having that car in the company and having some kind of car allowance paid to you instead. So just understanding the tax cost of your company car can make a big difference. Trivial gifts exemption is a small relief, but still worth claiming. Essentially, you can pay employees, or you can buy employees gifts of up to £50 each. It can't be cash and it can't be exchanged for salary, but you can buy employees, for example, Amazon gift vouchers or a Christmas turkey or whatever it might be. There's no tax to pay on the employee, so no PAYE national insurance, and the company will get corporation tax relief on that as well. So it's quite a nice little perk to benefit from, and directors can benefit from that as well, although they're capped at £300 worth of gifts a year. But so it's not a huge amount, but it's still worth claiming. There's a similar exemption as well for staff events like Christmas party. It has to be an annual event, so again, Christmas party, summer barbecue, things like that. You've got an allowance of £150 per attendee, so not per employee, this is per attendee, to throw an event, and there's no PAYE costs again for the employee, and the company will get corporation tax relief as well. Business use of residence, so that's where you can make a claim for working from home. It's a tax-free amount you can get from the company. Recently just been increased to £6 per week. It's adjustment we normally put through the accounts at the last minute. Again, it's worth claiming because it will save you a couple £100 of tax, and the company will get the corporation tax relief as well. Push bikes, you can have a benefit, a tax-free benefit in kind for a push bike. So if you are a keen cyclist, then it's worth acquiring that in the company. Likewise, having a company mobile phone or laptop, it's tax efficient to have that in the business, because as long as they are used for business purposes, there's no tax cost on the individual, even if there is some small levels of personal use as well. And the final one is a long service award. So this is where if you've got an employee that's been employed for at least 20 years, then they can have a one-off gift to reward them for their service. The gift is £50 per year's service. So for 20 years, that would be £1,000 you've got to put towards a gift. It can't be cash again, but we've seen it before where it's worked well with things like holiday vouchers, which probably quite isn't the right time at the minute, but it can be anything. It can be a new telly or whatever you think the employee will like. So just moving on to some tax reliefs for individuals. we believe that we've got stats to say that there's £830 million of unclaimed pension tax relief. So again, it's a huge number where people aren't claiming tax relief that they're entitled to. And for pension contributions, there's a few different ways that the relief can be benefit individuals. So we're looking at personal pension contributions that are made, and I think most individuals now are making personal pension contributions because of the introduction of auto enrolment and workplace pension schemes. And the way that reliefs applies is that if you're a higher rate taxpayer, we can claim additional relief on your tax return, whereby it extends the amount of your basic rate band, which basically means you're able to pay more tax at the basic rate of tax rather than paying more at the higher rate of tax. So it's shifting some of your income from a 40% tax rate to a 20% tax rate. So that's definitely worth looking into if you're not making a claim for that. The personal pension contributions that you can claim for, they're only the contributions whereby your pension provider are able to claim 20% tax back from HM Revenue and Customs. Some employers are operating a salary sacrifice scheme whereby the pension contribution is coming out of your pre-taxed income. So those contributions won't qualify because you would have already received the tax relief at source through your pay slips, through your payroll. The other thing just to mention about personal pension contributions is it works well because it increases the rate at which you start to repay child benefits. So if you're in receipt of child benefits at the minute, if your income exceeds £50,000, you start to have to repay those child benefit payments back to the revenue up until your income reaches £60,000, at which point the whole amount is repayable. So pension contributions just moves that band where those benefits start to become repayable from £50,000 to £60,000 to, so if you made £10,000 of pension contributions, that band will increase up to £60,000 to £70,000. And likewise, like I was explaining earlier with the tapering of the personal allowance, so when your income exceeds £100,000, you start to lose your tax-free personal allowance. Pension contributions will defer the point at where you start to lose your tax-free personal allowance. Just a quick point on entrepreneurs relief. Again, it's a very valuable relief for business owners that has to be claimed and has the effect of reducing the amount of tax payable when you dispose of your trading business. The way it works is that any gain on the sale or disposal of your business would normally be taxed at a rate of 20%, and by claiming this relief, it reduces the rate of tax down to 10%, so it is halving the tax cost on the disposal of your business. The lifetime limit here has recently been decreased to £1 million. So this relief, if you've got a gain of £1 million or more, this relief is worth £100,000, and it is definitely worth claiming if you are in a situation where you've just disposed of your business or are about to dispose of your business. There are various conditions to be met. So broadly, it has to be a trading business. For companies, you have to be an employee or officer of the company and have a material interest, which is at least 5% for the last 2 years. So it's just worth making sure that you're claiming that relief if you have or are in the process of selling a business. Some income tax reliefs, some smaller income tax reliefs that we often see are being utilised. Gift aid charity payments. This is similar to the way that you get additional tax relief on pension contributions. So again, if you've made any payments to charities and you've paid them via gift aid, so the charity can reclaim some tax. If you're a higher rate taxpayer, you can claim additional relief to increase the level of your earnings that are taxed at the basic rate band of tax rather than 40%. So it's worth keeping a note of any gift aid charity payments that are made. Business use of home I touched on earlier. Obviously, there's been a requirement for a lot of employees to work from home since March this year. So for a lot of people, it'd be worth them claiming a deduction from their earnings of £6 per week, which is the most you can claim without keeping any detailed records of what your actual cost is for working from home, which I think for most people would be the simplest way of doing it. And again, it's just going to reduce your taxable earnings, which in turn will reduce the amount of tax that you'll have to pay. Business mileage. So if you're performing any business miles within your employment, then you are able to receive up to 45p per mile for the first 10,000 miles that you complete. Any miles in excess of 10,000 you're able to claim a 25p per mile. If your employer pays you at those rates, then you're able to receive those amounts tax-free. If your employer pays you no business mileage or a lower rate than the 45p for the first 10,000 and then 25p thereafter, you're able to make a claim to reduce your taxable earnings, which again will reduce the level of tax that you're paying. So it's worth just looking at that one just to see whether you can make a claim for that one. And also professional subscriptions as well. If you make payments of any professional subscriptions, and there is a list of them on the HMRC website that will qualify, again, you're able to deduct those from your earnings, which will reduce the amount of tax that you can pay. The final slide is in relation to inheritance tax. So inheritance tax is a wealth tax, and broadly speaking, any assets within your estate that you hold when you die is taxed at a rate of 40%, so far that they're above your nil rate band that is available to you. So everyone has a nil rate band of £325,000. We have to take into account any gifts, any lifetime gifts that you've made in the last 7 years. So if you give your children £200,000 within 7 years of your death, then we effectively bring that £200,000 back into the estate. Or likewise, if you gift anything and you retain a benefit. So for example, if someone gifted their property, their home, to their children, but continue to live in that property, for tax purposes, we will treat that property as though it's still owned by the person who's passed away. So any assets held over the £325,000 is taxed at 40%. So it can be a very expensive tax, especially with the value of property and other things these days. There are additional reliefs or nil rate bands that can be claimed. There is a transferable nil rate band, which means that if your spouse predeceases you, then you are able to take on any of their nil rate band that they don't use. So very often that can be used to double the amount of allowances that's available to you. And there's also fairly recently been a residence nil rate band which has been introduced, which has the effect of increasing further the value of assets you hold in your estate. And again, it's a relief that needs to be claimed, and you can qualify for this relief if your home passes down to your descendants. So we're looking here at passing down to your children or your stepchildren or grandchildren or something similar. And also your gross estate has to be under £2 million to qualify as well. So we just need to look at those conditions and make sure that you're able to benefit from that relief as well. All of them are very valuable reliefs, and again, well worth claiming. The final very valuable reliefs are agricultural property relief and business property relief. Agricultural property relief basically means that you pay no inheritance tax on the value of any agricultural property held within your estate. So that will typically be things like farming interests, farmland, woodlands, stuff like that. And business property relief means that you don't pay inheritance tax on the value of your trading business. And again, that can be an extremely valuable relief. The only other thing I'll quickly mention on business property relief is sometimes you might, for example, have a business where there's non-business assets. So that might be some properties or plant that's not used within the business. It might be surplus cash that isn't required in the business. So you just need to be careful if there's anything like that, because that won't qualify for the inheritance tax relief. And also, if there's any investments within the property as well, that could taint the business so that it won't qualify for BPR. And that's definitely worth reviewing if you have got any investments, i.e. you might have a rental property in your business, or you might have some investments in stocks and shares in your business. It's just worth checking to make sure that that company is still going to qualify for that relief. So that was everything I was going to run through. Like I said, it was a very quick overview of quite a few different subjects. Hopefully it's identified some areas where you might be able to claim additional relief. If you do have any further queries or wanted to sort of understand any of those areas in any more detail, then feel free to contact myself or anyone else at Knights Lowe, and we'll be more than happy to help. And have you got any questions there, James? Has there been any questions that's come in?
Yeah, thanks for that, Kirk. I think, yeah, like you say, that gives a good overview, and there's lots of points there. Some of them smaller, some of them larger, but the R&D and the capital allowances is something that's certainly very topical at the moment, and capital allowances, I think, is the one area that often gets missed. I think you'll agree, Kirk, that you pick up clients or businesses where they've not thought about the integral features, they've not thought about the plumbing and the heating and that sort of element when they've done some adjustments or building work. So
yeah,
that's
they're big numbers as well, aren't they? Them ones, you know, if you're talking about a one-off tax reclaim of, you know, £50,000 to £100,000, which it can easily be, then, you know, that can make a big difference with that business, especially with what we're going through at the minute with COVID-19 and a lot of businesses sort of struggling with cash flow. So it's definitely something that's worth looking into.
And one of the questions that I've got here relating to the capital allowances is, can you go back, if you've got a property now, can you go back and look at the position, the historic position?
Yeah, absolutely. There's no time limit on making a claim to capital allowances. The rate you get relief at does change, because you can, if you make a claim in the same period that you incur the expenditure, you can claim what you call annual investment allowance. Annual investment allowance means basically that you get the full relief, up to 100% relief in the year of the expenditure. And that allowance is currently £1 million. It's about to go down to £200,000 in December. So it is better to make the claim in the year of the expenditure. However, if you don't make the claim in the year of the expenditure, you can still make a claim in future periods, but you'll have to wait longer to get the relief. So you'll only get either 18% or 6% per annum tax relief, and that the balance of the relief will roll forward to future years. So definitely worth looking into still, if you know, even if it was some years ago since you've acquired or spent money on any property.
Okay. And there's a similar one here about R&D. How many years can you go back? Can you go back, or is it just a current year claim that you'd be looking to do?
Yeah, so you can go back. You can effectively make a claim for 2 years at any given point. So if you had a year end of the 31st of March, for example, you are in time to do the 31st of March 2020 claim. So you can make that one. You can also go back a further year, and you can still make a claim for the 31st of March 19. So you can go back 2 years, and then that is your limit on that.
Okay, great. And then sort of a final one that just picks up, that's been a question I've been asked by a few people recently, is with the working from home allowance, your employees can claim that. You don't necessarily have to pay them the £6, but they can actually go and claim that amount, can't they?
Yeah, exactly right. So again, it's up to the business as to whether they want to pay that tax-free allowance to their employees. If it's not paid to them, then the employees can deduct that from their taxable earnings. So they can include it on their tax return, claim tax relief on it, and that will reduce the amount of tax that they're paying on the amounts that they have received from their employment.
Yeah. and they can also do that without actually claiming doing a tax return. There's a form that they can do online, so it is possible for you. You can tell your employees they can go and make that claim, and it's a small benefit from the position we found ourselves in over the last few months.
Yeah.
Okay, I think that brings us to a nice point at that point. Thank you very much, everyone, for joining us. I'm sure there's something interesting there for everyone. Again, it's to highlight some issues. If you've got anything where you think you want to look at further, please do contact us. And I look forward to you all joining us again next time. Thanks a lot.